Welcome to the Alpha Mind podcast with myself, Stephen Goldstein, and my co-host, Mark Randall. This week, we are delighted to have on the podcast Morgan Housel, author of the outstanding new book, The Psychology of Money.
The psychological side of money is not just an important aspect of finances. I think it is the single most important aspect of dealing with money. And if I can expand on that point just briefly, I would say, look, if you are the best stock picker in the world, you are the most sophisticated economist in the world, you have the best forecasting model, but you are unable to keep your cool during 2008, or if you panic in March of 2020, none of your analytical abilities matter. So the psychological side of investing is important because it can so easily neutralize the analytical skills that we value so much in finance. So it's not only an important part of finance, I think it is the single most important part of finance for that reason.
Before we start, a quick word about the Alpha Mind podcast sponsor, the Society of Technical Analysts, the STA. The STA are one of the world's leading professional bodies serving the technical analysis and trading communities. We are delighted to announce that as a result of our partnership with the STA, listeners to the Alpha Mind podcast can now receive a £100 or local currency equivalent discount on the cost of their world-beating home study course and the home study course and diploma package, which offers diplomas accredited by CISI, the Chartered Institute for Securities and Investments, which is a global professional body for those who work in the financial and investment profession. The study course is an online replication of the full STA diploma program, which is delivered annually at the London School of Economics. The modules are produced by some of the leading figures from the world of finance and cover a wide range of topics. There is not a more thorough and professional program in the world. This is the gold standard, and as well as upgrading your knowledge and expertise, this will be a major boost to your resume or CV. Participants in this program typically include traders, both retail and professional, portfolio and fund managers, investors, analysts, trading system designers, financial journalists, and anyone curious to understand more about price action analysis techniques. Now, to take advantage of this offer, just visit our blog page, alphamindblog.blogspot.com, or Google the Alphamind blog, and on the pages at the top you will see a page for the STA Home Study course. There you will get details of how to get the £100 discount, or email us info@alpharcubed.com. Now, on with the podcast. Okay, so we have Morgan Housel, who is the author of a fantastic new book, which by the time we've done this episode should have been released, called The Psychology of Money. Morgan is a partner at the Collaborative Fund and a former columnist at the Motley and the Wall Street Journal. He is a two-time winner of the Best in Business Award from the Society of American Business Editors and Writers, winner of the New York Times Sydney Award, and a two-time finalist for the Gerald Loeb Award for Distinguished Business and Financial Journalism. His book, The Psychology of Money, as I've already mentioned, is out on September the 8th, which is when we should be releasing this podcast. And I've just read the book and it is absolutely astounding. That is all I can say.
Thank you very much, Stephen.
Anyone who's listening to this and hasn't read it yet, you are in for a treat. So welcome, Morgan, and maybe you could just tell us a little bit about The Psychology of Money and what inspired you to write it.
Sure. Thank you again for having me, Stephen. Thank you for those kind words. What inspired me to write this was this. I've been a financial writer for my entire career, and I started as a financial writer in 2008, which of course was the beginning of the great financial crisis, leading into the worst recession of our lifetimes at that point. And as a writer, I just tried to answer the question, why did the great financial crisis happen? What caused it? What caused people to make those crazy decisions about greed and risk and scarcity and those kind of things? And there was no light bulb moment, but over time, I kind of realized that the answers for why the financial crisis happened could not be found in an economics textbook or a finance textbook. You could only find them in a psychology textbook or a sociology textbook, a history textbook. Those are what contain the explanations for why people made the decisions with risk that they did during the run up to the financial crisis. Which just kind of led me to this idea, this view that the psychological side of investing and economics and money in general is so incredibly important. And it tends to be overlooked because it is not analytical. You can't sum it up with charts and formulas and spreadsheets. It's a much softer, mushier topic. So it tends to get swept under the rug in investing, even if it is so fundamentally important to how we think about risk, how we think about opportunity. And what's really important about the psychological side of investing and money that I get a lot into in the book is that investing is not the study of finance. Investing is a study of how people behave with money. And because it is a study of behavior, it incorporates all the lessons and rules from all kinds of other fields and industries, parts of areas of the world that also study human behavior. Things like medicine and sociology and psychology and politics and military history, all of these other fields that incorporate or just have to do with people dealing with risk and opportunity and scarcity can teach us really fundamental things about how people think about behavior that can help us become better investors, better with our money. So that was kind of the motivation for the book. Was just kind of the last decade of realizing slowly, I would say, that the psychological side of money is not just an important aspect of finances. I think it is the single most important aspect of dealing with money. And if I can expand on that point just briefly, I would say, look, if you are the best stock picker in the world, you are the most sophisticated economist in the world, you have the best forecasting model, but you are unable to keep your cool during 2008, or if you panic in March of 2020, none of your analytical abilities matter. So the psychological side of investing is important because it can so easily neutralize the analytical skills that we value so much in finance. So it's not only an important part of finance, I think it is the single most important part of finance for that reason.
I'm so delighted to hear you say that. I have a quote which I use so often with people, and it's a quote by Howard Marks. And it says, "The discipline which is most important in investing is not accounting or economics, but psychology."
Of course. Yeah,
And they don't come smarter than Howard Marks in the world of investing.
that's right.
So to, when I saw him say that, when I read the quote that he said that, I thought, he's banging on about something which I feel I've been banging on for ages about. And when I read your book, as I was reading through it, and I'm starting to think, as usual, even before I picked it up, I'm assuming this is a behavioral finance book. But it's not. It's emotional finance. It fits in this emerging category which is coming out over the past few years of a subject which I think is truer than anything about investing, that finance is emotional.
Yeah. And it's emotional for everyone, regardless of how smart you are. You can have an MBA from Harvard and be a partner at Goldman Sachs and work in the most sophisticated hedge fund. But if you are emotional, and everyone is, and you don't have control over your emotions, and you have not nurtured them because you've only focused on the analytical side of finances, you're going to have a really hard time in investing, even if you are the smartest person in your field. I've made the point before that, there are people in finance who have no financial education, no training, no background, no experience, and they can vastly outperform people in the industry that have the best education, the best training, the best background. That happens, and it happens fairly often. You have people who have no idea, no experience in finance, but if they can dollar cost average into index funds and leave them alone for 20 or 30 or 40 years, they will do extraordinarily well. And then at the same time, you have people who went to Harvard, worked at Goldman Sachs, the best training, and go bankrupt during bull markets. I don't think that happens in any other field. There's no other field where people with no training, no background, no experience can outperform people with the best training, the best background, the best experience. It's impossible to think of someone performing, of a layperson on the street performing open heart surgery better than a Harvard trained cardiologist. It's impossible to think of that. But the equivalent does happen in investing. And the reason why, as you alluded to, is because so much of what matters in investing, I think the majority of what matters, is not necessarily what you know, it's how you behave or your control over your emotions with money.
Yeah, and it's almost like I feel that I'm sometimes fighting a lone battle. I mean, Alpha Mind, this podcast, is really about the emotional side of trading. We speak to people about that. I often use the analogy that, if you want to make the best analogy for trading or investing is tightrope walking. That's what I think it is. It's surviving to cross the wire.
That's right, right. Just getting to the other side matters more than anything.
I use this analogy all the time because I say what happens is you learn and you think it's what happens when you're doing it 2 feet off the ground. When if you fall, you're going to get a few bruises and nothing more than that. And if you think you learn at that level, you then think you can do it at 200 feet off the ground. But what happens is your emotions kick in, your fear kicks in. So it's the same job theoretically, but completely the different job in practice. And I kind of got the sense that was almost the essence of your book from start to finish, which was told brilliantly. I mean, as I read it, I only realised you were formerly a writer afterwards. But I'm thinking you must be a writer.
That's all I've done in my career. So I'm glad that I've picked up some competence at it over the years. Thank you.
Well, that was a great thing. You told a story. That's the beauty of it. And you told it reads like a story. That's why I couldn't put it down. There's a lot of great books that talk about subjects similar to this, but you kind of lose interest because they throw out big research reports, articles, data, stats, charts. I notice there's very few of those in this book.
Well, here's what's really important about the structure of the book that I really put a lot of thought into this doing this is I am a big reader. I read a lot of books. I read a lot online. But if you're talking about books, I should say I start a lot of books. I rarely finish books. Maybe I'm making this up, but maybe 1 in 10 books that I start do I finish. Maybe it's less than that even. I think that's true for a lot of readers. Even books that I like and books that I recommend, a lot of them I didn't finish. I didn't make it past chapter 4 because you read it, you read the introduction, you get the point, and you say, okay, I get the point. That's a really good point. I learned something, but I don't need 25 chapters of repetition after this. I get the point. Let me move on with my life. I really wanted to avoid that in this book. The reason that occurs is because most books are about one point and they ramble on for 60,000 words about that one point, and that point could have been explained in 3,000 words or less. So for this book, what I wanted to do was rather than making one point that I ramble on about, I wanted to make 19 separate points, 19 separate chapters that are all distinctly different. They could all live on their own. They have a connecting theme, but you could start this book on chapter 17 if you wanted to, and it should make sense. Every chapter is kind of makes an independent point on its own, and the chapters are not that long. There's actually one chapter in there. It's my favorite chapter. That is 1 page long. It's about 400 words. It's slightly less than 1 page. And when I turned that in, the publisher said, "Is this a mistake? Are you missing something here?" And I said, "No, that's all I have to say." And they said, "Well, this is a book. Do you want to expand on that a little bit?" And I said, "No, that's all I have to say. And out of respect for the reader, I just want to leave it at that. I have nothing else to say." So that was really important to me. That the metric that I want to maximize for this, and there's no way to really track this, but are the number of readers who finish the book, not just who buy the book, but finish it. That's a really important thing for me because that's what I want as a reader. I wish people, as a reader, I wish more writers would respect my time, respect everyone's time, and rather than just droning on for chapter after chapter about the same point.
Okay, now I'm guessing that chapter is the man in the car paradox,
That's it. It's about 1 page long.
which is the first note I've got to ask you
Good.
about, because I love that idea that no one is impressed with your possessions as much as you are.
That's right.
And just I don't know if I explained, I'm a coach. I work with traders and investors, and probably the biggest challenge that I meet when I'm out there coaching people is people worrying what other people think about them.
Yeah. And to me, this point that I make in the book, I learned in college when I was a valet at a very nice hotel in Los Angeles, and people would drive in Rolls Royces and Bentleys and Ferraris and Lamborghinis, which I loved. I loved then and I love now. I think they're amazing cars. They're beautiful. I love them as much as anyone else. But it occurred to me that when someone drove into the hotel with a Lamborghini, everyone stopped and gawked. They turned their head and they said, "Wow, look at that." But nobody, including myself, actually cared about the driver in the car. Everyone, including myself, was imagining themselves in the car. When someone pulled in a Lamborghini, I intuitively thought, I did not think, "Wow, look at that driver. He must be cool." What I thought was, if I was in that car, people would think I'm cool. And the irony was not obvious to me until I really thought about it in terms of I want that car so people will think I'm cool. But I don't think the guy who's driving it is cool. I'm not paying any attention to him. That's the man in the car paradox that I think is so important in investing. And look, this is not a plea for people to live like a monk. I like nice stuff. I like nice cars, I like nice homes, I like nice clothes, all of that. But I think when you really dig into why you want something, if one of the main reasons that you want something is because you think if you have it, people will give you a lot of respect and admiration. Take a pause and really think about how much you admire other people for the nice stuff that they have. And I think if you're honest about it, you will see that it is less than you think. And if you don't admire people for their nice stuff, why would you think that people will admire you for your nice stuff?
Yeah, and that's a really interesting point, and it's something I try and get people to kind of swallow that point of view that if a lot of people I work with are sitting in trading rooms with a lot of other people around them, and they're worrying what other people think about them, and it's impacting how they work. And I say to them, try not to worry about what that person there or that person there is thinking about you, because what's going on in their head is they're worrying about what you think about them.
Exactly.
they don't really they don't really care about you.
Nobody is thinking about nobody is thinking about you more than you are. But everyone thinks that other people are looking at them. You see this a lot in a lot of social situations where if you're out going out with a group, maybe you have one person who says, "Oh, I'm so embarrassed that I'm wearing jeans to a formal dinner," something like that. I'm making this up, and you always want to tell that person, "No one cares. No one's looking at your pants. Who do you think you are that people care what kind of pants you are wearing? Just go, and no one cares about you. No one is thinking about you more than you are. So check your ego at the door. Everybody is in this situation. Everyone who is going into the dinner is thinking about what they are wearing or what they're going to say. And they don't really care that much about the other people because all of their mental bandwidth is focused on themselves. I think that is just a natural form of egotism, an innocent form of egotism that a lot of people fall for.
Yeah, and that's human nature, and we can't help that. And I think if I'm honest, this destroys people so often. It destroys so much wealth. I was explaining a story to someone just this afternoon about a client I worked with at a hedge fund a few years ago, and this individual had a really good year. He'd made about 8%, which came in one trade, one short-term trade
Hmm.
on the Italian bond market. And it was a particularly bad year for the hedge fund, so he happened to be one of their top performers.
Hmm.
And his style was very short-term, which wasn't really respected in the fund. The fund was a macro fund. What's respected is long-term trading. And he said to me at the end of the year, he said, I think I'm going to try and move my style to become a long-term trader. And I said, why? And he said, well, it's just considered more in vogue in this firm.
Yeah.
And I said, look, I know your personality. I've done the personality psychometrics on you. You're in a place where, you know, your gift is short-term trading. You feel the market. You feel where value is. You feel when it's right to get out, and that what makes you a brilliant short-term trader. And you're going to throw that away because you want to appear good to everyone else in the firm.
Right.
And he was willing to do that. And I think he stood back on it when he thought about it. But a lot of people are willing to do that. They're willing to throw the baby out with the bathwater.
It's just that just to socially conform to others. I think there's almost another side of that. It's not the opposite, but it's kind of a different side of that. Of people need to embrace what they are bad at as well, particularly from the behavioral side. And rather than thinking that you can fix your flaws, if you have a hard time with greed and fear, if you have a hard time with those things, rather than thinking that you can fix those and you are capable of really altering your mind in a major way, I think it's much more practical for people to just embrace the flaws that they have. If you have a lower tolerance for risk than you would like, rather than trying to improve your mind and bend your mind towards a person that you want to be, I think it's much more practical for people to just embrace that with both hands and situate their finances so that their asset allocation, their investing strategies, uh, really marry their personalities. Rather than trying to say, oh, well, if other people do this, maybe I should do it as well. Even if you have kind of a personality quirk that is not really coherent to that strategy is really important.
Yeah, you've got to work with who you are
That's right.
and who you are emotionally. And this is about to bring me on to something else, which I want to talk about in a second. But I'm going to lead that because one of my favourite lines that you talk about read the book all the way through, and I do the same as you. I read a book, I get to the end of the first couple of chapters. Yeah, I've got the point of the book. I don't think I need to read on anymore. Your book and anyone listening is not that book. It's a book to read from cover to cover. And just to sort of hammer that home, one of my favourite points is right at the end when you talk about when you bought your house.
Yeah.
And I'm just reading back to the comment you made, which was, I thought it was a fantastic comment. It probably needs a little bit of explaining from you.
Yes.
And it's the one where you said, we own our own house without a mortgage, which is the worst financial decision we've ever made, but the best money decision we've ever made.
Yes, that's right.
And I'd love you to expand on that just for a second.
Sure. So we don't have a mortgage on our house, which is a terrible financial decision because in the United States, you can get a fixed rate 30-year mortgage for 2.9%. It's the cheapest money you will ever come across in your life. And I know with high confidence that the stock market will return better than that over the next 30 years. So why would I decline government subsidized, cheap, almost free money in real terms when I could have invested it somewhere else? That is what makes it a bad decision. And I cannot justify paying off our mortgage in any sort of financial terms on a spreadsheet. But it is the best money decision that we've ever made. It's the one money decision where my wife and I looked at each other and high fived and said, oh my gosh, we did it. We own our house outright. It gives us a level of stability and security for our children that no one can ever take our house away from us, no matter what happens. It's ours. We actually own it. A lot of people say they own their homes, but very few people actually do. The bank owns your home. Doing that was really important for us because our financial goal is not to maximize returns, it's to maximize for how well we sleep at night. It's using our money to actually legitimately make us happier rather than chasing some sort of false goal about, oh, I've done so well this year. I outperformed the benchmark. I have the highest ROI on our net worth and I can achieve. That just seems kind of theoretical to us. What really matters is how can we use our money to make us happier? And for us, this is not the case for everyone. This is why this is not a recommendation for other people to do it. But for us, it was having that level of security and being able to tuck our kids in at night and be able to look at them and say, everything's going to be fine no matter what happens in the world. This is your house. No one's going to take away from us. That meant everything to us. That was so important. And I think the ROI that we got on that decision, let's call it the mental ROI, exceeds almost anything else that we have earned in terms of actual financial dollars and cents ROI. It was really important and powerful to us. So I think that that framework is not something that I recommend for everyone. I think there are a lot of people that can benefit from that. But if you have a different mindset, then I think that's great. I think what is important for everyone, though, regardless of what the actual decisions you make with your money, is doing things with your money that actually make you happy, rather than trying to say, oh well, I'm supposed to maximize the returns on my investment, so that's what I should do. There's no iron law that that's what you're supposed to do. I think rather than being purely rational, coldly rational with your money, it is much better to just try to be reasonable with your money rather than trying to make all of the dollars line up in the spreadsheet to the most maximized extent that they can. Just try to say what is reasonable to do with your money, even if you can't justify it on a spreadsheet. For us, that was paying off our mortgage, which makes no sense on the spreadsheet. For other people, it might be day trading with 5 or 10% of your portfolio because that scratches some itch that you have. And even though if that's a for a lot of people not necessarily a great thing that they can do with their money, if it is a reasonable thing that you can do with your money and it makes you happy, then I think it's the best thing that you can do with your money. I think there are a lot of things that don't make sense on a spreadsheet that make perfect sense at the dinner table when you're making decisions with your family or with your spouse that make a lot of sense for people that people should embrace to a higher degree than they do.
Yeah, yeah, and you came on to the next point, which was one of the red threads that runs through the book about being reasonable, not rational, um, being psychologically reasonable. And I'm mindful of a question that I was asked yesterday. I know you were on the Real Vision event yesterday,
Yes.
talking about this book, and I was a panelist with Denise Scholl and Gio Valianti, and it was a question was put to us. Someone said, I've got a portfolio at the moment of stocks that I'm managing. I've only got two on at the moment, and I'm told I should have a lot more than that. What should I do? And the question there was that the two were the only ones that he saw at the moment that he felt he wanted to be in. And my answer was that if that's what you feel is right, that's what you should do. Not because you should be told that rationally you should have a completely um, a portfolio with 20 stocks in it.
We all have different backgrounds. We come from different countries, different generations, different neighborhoods, different families with different values. So we've all been brought up to think about the world in very different ways. So we all have a different model about how we think the world works. And therefore, we're all going to come to different conclusions about what is right with our money. And the idea that if you accept that, then the idea that there is a one size fits all answer for all of us doesn't make a lot of sense. So I really try to make that point of I can tell you what I do with my money, But I always have to have this asterisk of saying, look, this works for me, but it might not work for you. Maybe it works for you, but it might not. You might think that's crazy. And I might think that what you do is crazy. And the fact is that neither of us are crazy. I don't think anyone is crazy. That's the chapter of the title of chapter 1 is No One is Crazy. Because a lot of times when we have a debate in finance or we are arguing about something in finance, we're not actually arguing. All we're doing is reflecting the fact that we see the world through a different lens because we come from different backgrounds. That's a really important point, I think, to understanding a lot of financial debates and also accepting that reasonable, educated, informed people can and often do come to very different conclusions about what to do with their money.
Yeah, and it doesn't make you wrong just because you have a different view to them. As you say, you are coming from a different
That's
place.
right. Yeah. What's very different, someone in the United States has seen just a very different lens of the world than someone in the United Kingdom. I make this point. I don't want to go too far down a rabbit hole here, but what's really interesting in the last 70 or 80 years, why did most of Europe have a higher demand for social safety nets than people in the United States did? Most of Europe has a higher demand for things like universal health care and greater unemployment benefits than people in the United States do. To me, the best explanation for why that is this. A lot of Europe after World War I and World War II was left in rubble, was left in tragedy, literally bombed to rubble. And at the end of that, when you had unspeakable poverty in many parts of Europe and Japan, particularly after the end of World War II, you had a much greater degree of society coming together and saying, I want to protect my downside. I have seen devastation. I have seen mayhem. It is brutal. I don't want to experience it again. I want to protect my downside, even if it comes at the expense of upside growth. The United States, of course, paid a human toll in World War II, but we did not pay a local toll. We were not bombed to rubble. We were not. We suffered no physical local devastation, and therefore, at the end of World War II, it was much easier for people in the United States to say, "I want to swing for the fences. Don't protect my downside. All I care about is upside." Now, it's important to point out that people in the United States are not smarter. They don't have better information than anyone else in Europe. We just saw the world through a very different lens. And even if we're trying to be open minded to what people dealt with in the Blitz or to what someone living in Dresden or Japan during the World War II, we can try to be open minded to what that was like. But we don't have the emotional scar tissue that people who lived through that did. And therefore, we're going to come to very different conclusions about what is worth it in the economy and to do with our money. I think that's one example of a broader point that people with different backgrounds who've seen the world through a different lens come to very different conclusions about what they should do with their money.
No, absolutely. I just want to move on a little bit because I want to go through. I've made. I don't know if you can see my book. I don't know if you can see me on the video, but I've got
Yes.
little tabs everywhere. As I say, it is one of those books. I want to go on to this bit about tells because I mean, it's. I would call this book almost very Talebian. Nassim Taleb is mentioned. He's kind of, and he's a little hero of mine.
He's a hero of mine too. He's been a big influence on me. I wish he wasn't quite so much of a jerk as he normally is, but I think he's one of the great thinkers of our time.
Yeah, he comes at a cost.
He's quite prickly at times. Yes.
Yes, yeah, but I mean, I love his view. I love his perspectives. I love how he looks at the world. Actually, just before this, I'd reread Fall by Randomness,
Hmm.
um, and I got so much more out of it the second time round.
It's a great book.
There,
Yes.
yeah, there's a part here tells you in chapter 6, 69, which again it was one of those chapters which I just loved the way you told the story about it, and it's it starts with that idea that you could be wrong half the time and still make a fortune.
Right, which is not intuitive.
It's challenging for a lot of people.
I
A lot
mean,
of people fear loss so much.
yeah. And the point that I make is even if you were to look at the most conservative investing strategy, a broad index fund of large cap companies, the S&P 500, the broadest, like the most basic index fund over time. If you look at the history of the components of a broad index like that, of 500 or more companies, over a period of about 20 or 30 years historically, upwards of 40% of them have gone out of business, not merged with another company. They have failed as businesses. But in the meantime, the S&P 500 has done very well over time because effectively all of the gains come from about 7% of components that are extreme winners. Amazon, Microsoft, Google, Walmart, those kind of companies account for virtually all of the gains. It is not intuitive to think that if you make 500 separate investments, that you're going to lose effectively all your money on almost half of them. and still do very well over time. But that is how a lot of successful investing works over time. That's how a lot of of things in life work over time. That tails drive everything. It's true in business, it's true in investing, it's true in politics, it's true for military, almost everything that has growth over time, or major outcomes over time, is driven by a very small minority of events. So it's just, since it's not intuitive to think that the definition of success is losing is being wrong half the time. A lot of people, it really astounds them psychologically, and as they go through investing, they feel like they are failing because they put a lot of mental thought and capital behind these decisions that didn't work out. But that's how it works. Even if you look at someone like Warren Buffett, he mentioned a couple years ago that over the course of his life, he has owned 500 stocks roughly, and he's made virtually all of his money on 10 of them. And that was before Apple. Now he has made, I'm fairly sure he has made more money in dollar terms, at least, on Apple than every other stock public equity investment he has ever made ever. Just that one investment. Benjamin Graham, the godfather of value investing and Warren Buffett's mentor, was a very successful fund manager, a very successful investor, as you would imagine. 100% of his career success is owed to one investment, Geico. If you remove Geico from his track record, Ben Graham's track record as an investor is average at best. And what's interesting about Geico too is that Ben Graham broke every one of his rules that he lays out in his books to buy Geico. It was way oversized. It was not necessarily cheap when he bought it. It broke his rules, but that is the single investment that accounts for his returns. And I think if you look at a lot of even companies, it's the same way. Amazon has experimented with dozens of different products over the years, but virtually all of its success as a company is owned to two products, AWS and Prime. That's all that moves the needle. Apple has made dozens of products over the years as well. Virtually 100% of its success is owed to the iPhone, one product. I think for a lot of companies, you will see that a very small minority of the attempts to make money account for virtually all of the successes of making money over time as well. So you really need to nurture yourself to understand that point, because it is not intuitive, and when you deal with it in real time, it can be very disheartening if you don't wrap your head around that point.
Yeah, yeah. I mean, you beat me to it because I'd already turned to the page about the Warren Buffett with his 10 stocks out. Because I was amazed when I read that. I must admit, I had no idea it was that. I
Now,
assumed
now
it was
granted,
about 10%.
he is referring to that, I think, in dollar terms. So if you were to look at in percentage terms, I'm sure when he was 25 years old, he had some stocks that went up 100-fold, something like that. But in dollar terms, it's very few. I also make the example of the book of Walt Disney. If you go back to his early career, like in the 1920s and 30s, there was one point where he had made about 400 different films, and virtually every one of them had lost money. So he was very good at making films that were very popular, but he was a terrible businessman. They all lost money, and he was bankrupt at the time. And then he came out with Snow White and the Seven Dwarfs, and that changed everything. He made like something like $8 million from the film, which is a lot of money back then, and that completely transformed the trajectory of Disney Studios. So at that point, he had made 400 films, and the only one of them that mattered at all was the 90 minutes or so of Snow White. So here again, 1 out of 400 is what completely transforms the company and moves the needle.
Yeah, yeah, no, absolutely. And again, there's a theme within that, and I'm trying to think whether this is, and it's not chasing crazy dreams, but it's giving them a chance to happen. So
Yeah.
you make a point in the story, who I think it was John Bogle who told you the story. I'm never quite sure. Is it Bogle or
It's
Bogle?
Bogle. Yes. Yes.
Bogle, yes. About the story about the author who talks about he just said the word enough.
Yes.
And and it's a lovely story again about this guy having enough and being happy with it.
It's great. Yeah, it's about the novelist Joseph Heller, who was at a party with Kurt Vonnegut, the other writer, and they were at the party that they are at is at the house of a very successful hedge fund manager, and Joseph Heller says to Kurt Vonnegut, he says, this hedge fund manager made more money in 1 year than you made in the novel Catch 22, a very successful novel. And Joseph Heller says that might be true, but I have something he will never have, which is enough. And I think that's such an important point that, look, we can have aspirations and desires and goals and want to have progress and grow our money, but everyone needs to have some concept of enough. Because if you don't, you're probably going to keep swinging for the fences, keep taking more risk in pursuit of more until you find out that you've bitten off more than you can chew and go over the edge. I talk about in the book, in that chapter, the story of two people, Bernie Madoff, who everyone knows, and also a guy named Raja Gupta, who is less well known, but he used to be the CEO of McKinsey, who spent some time in jail for an insider trading charge. Now, what's interesting about Bernie Madoff, not many people know this, but Bernie Madoff, before he started his fraud, before he started his Ponzi scheme, was very successful, made tens of millions of dollars legitimately in the legitimately side of his business of market making. He had extraordinarily successful, very, very wealthy, but it was not enough for him. Even though he had made tens, by some estimates, hundreds of millions of dollars legitimately, it was so not enough that he needed to start a fraud and scam his family, scam his friends in order to get more money. Same with Raja Gupta. When he was CEO of McKinsey over his tenure, he made roughly $100 million, if I recall. Incredible sum of money, but it was not enough. I quote one of his friends in there. It says he didn't want to be in the 100 millionaire club. He wanted to be in the billionaire club. And therefore, he took so much risk that he ended up being part of this insider trading scheme that landed him in jail and completely torpedoed his reputation. So I think those are extreme examples, but everyone needs to have some idea of enough. Of look, I want to be ambitious, I have goals, but at some point I need to get the goalpost to stop moving. I think that's what it is. The most important financial skill, but one of the hardest skills, is getting the goalpost to stop moving. Because if it never stops moving, if your aspirations grow in lockstep with your success, then you're going to keep pushing the envelope until you realize that you have run yourself off the cliff.
And this is a point I make. We have a lot of retail traders listen to this podcast, as well as investors, and a lot of them are new to the game of trading, and uh, they come into this and they want to make, they want to make 10% a week
Yeah,
trading. Some of them tell me that, and I say, first of all, you don't know what trading is. At the moment, you're competing out there with guys who've been doing it for decades.
sure.
Okay, and don't mix up luck with skill. It's a little bit like you can walk out onto the poker tables having just learnt the game, and theoretically you could beat Phil Ivey, and some of the other great poker players, because there's so much randomness in how the cards are dealt, how the hands fall.
Yeah,
But if you play those guys over 100 games, they're going to wipe the floor with you, because they are great players, and trading is like that as well.
right.
But
Absolutely.
but there's another side to it, and I say to them sometimes, instead of trying to make, say, you know 20% a day or 10% a day, why don't you just try and make 0.2% a day? And they kind of look at me and are like, really? Why would I try and do that? Well,
Right.
I say, and I quote them this numbers, which is, well, if you start with, let's say you start with £20,000 or $20,000, and you can make 0.2% a day, theoretically, for 50 weeks a year. I said, after 8 years, you'd have grown that 20,000 to over 1 million.
Right.
2 years later, it'll be almost 3 million,
Right.
and 12 years later, it'll be over 1 billion.
Right. It's the kind of thing of like there's two parts of that. One is underestimating the power of compounding, and two
Yeah,
is the value of just reasonable expectations of what to expect in the market.
absolutely. And so many people go out there with this, they want the Lamborghini by the end of the year.
Right.
And they're never going to have it in 1 million years.
I mean, I think
You
what's
know,
really important in investing is to just ask the question, what are you being paid for? You can make a lot of money in the market, but why? What is the cost of that? What do you have to put forth? What is the price of success? By and large, the price of success, this is true for both trading and investing, is patience. Do you have enough patience? If you can put forth patience, if you can pay your toll in patience, then the market is more likely to give you something back in return. It's really important, particularly if you're a long-term investor, of course. You are paid. The cost of admission for good returns is patience and dealing with uncertainty and volatility. That's the cost of admission that you have to be willing to pay. And if you're not willing to pay it, you're just relying on a much greater degree of luck about not getting caught for not paying the cost of admission. You jumped over the fence to get into the theme park and you might get away with it, but you might get caught. Whereas, look, it's much more reasonable to just pay the cost of admission. It's worth the fee. You pay it and you'll have a great time. So if you're willing to pay the fee of investing, of patience and dealing with uncertainty, then the rewards on the other side, by and large, are well worth it.
yeah, it's interesting because I quite often get asked, can you coach me to be more patient? And I normally say, well, how long have you got?
That's such a good way to put it. Coach me to be patient, but I only have 2 minutes for you to get it done.
So, but you're right. Patience is a gift. It's one of those amazing gifts. But again, it comes back to that ego, that idea of I want people to see me, I want to look better than everyone else. It's so often connected, and I want to feel good because I want other people to see what I've achieved,
Yeah.
and that's the damage because the paradox of that is actually they never will if you think like that.
Right. And this is a slightly different topic, but I think it all ties into this. It gets more a little bit more philosophical. But Warren Buffett's definition of success is when the people who you want to love you do love you. I think that's a really beautiful way to phrase just what success is. And what it means is look, there are some people in my life who I desperately care what they think of me. My wife, my kids, my parents, my few very close friends, I really care about what they think of me. Almost nothing matters more than me than what my kids think of me. But it's that very small group. And what other people think of me, I really don't care that much about. Even if they think really highly of me, well, that's great, thank you. But I don't. It doesn't really mean that. And if they think very poorly of me, well, okay, that's not fun, but it doesn't really matter to me that much. So I think that's really important for finances too, is realizing that, like again, like we spoke about earlier, most people don't think about you. Most people don't really care about you outside of your family and your close friends. Most people are not thinking about you. You're thinking about yourself a lot more than other people are thinking about you. So if you just think of that, it just pushes you towards a different level of financial goals and thinking about what really matters to you.
How do you? One of the challenges with that is, I know that now. I'm grey-haired. What I've got left. I'm in my 50s. Um, I couldn't think like that in my 20s. I wasn't capable of it. I don't think.
Yeah,
Some people are, but we age and we grow and we have different priorities and a different world outlook. And it's almost like this needs to be taught at a young level somehow,
yeah.
and
I,
it needs to
here,
be imbibed.
well, here's what's really difficult. I think it's easier. So you're in your 50s, I'm 36. But even if you were to look at someone in their 20s, someone who is, let's say, not married, not established in their career, still trying to make a name for themselves, then the kind of putting out the outward appearance of success is very important. If you are single and you're looking for a spouse, you're looking for a mate, then your outward appearance is very important. But if you are comfortable in your marriage and you know that your spouse really likes you through thick and thin, then your outward appearance is less important. So there is a thing where it's maybe easier for you and I, Steve, to be talking about this than it is for someone who is younger, who for whom their outward appearance is really important. Another example of this at a different level is my resume, my physical resume in PDF form, and yours as well, probably means nothing to us anymore because we're more established in our careers. If there are career opportunities, our resume is not going to matter because they're through connections that we know. But if you're 22 years old and you are just leaving college, your resume is very important to you. You better make sure that it has everything written right and it looks beautiful and you're putting forth your best foot forward. So there are a lot of differences in signaling based off of just where you are in life. And maybe that's a really important point to make, that for some people like you and I, it's a lot different in terms of what we need to signal to the world than it is to someone who's just trying to break into the industry or just trying to find a spouse, let's say.
Yeah, yeah. No, 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 absolutely. And that again comes back to this idea of, how we see the world through certain lenses. It's not just about where we come from, but also where we are in life,
Right.
and the experience we've had
if
through
I
that as well.
if I dress like a slob, my wife will still love me. But if you're trying to get a first date and you're dressing like a slob, well, that's a problem for you. You're gonna have a hard time, right? So there are distinct differences.
Yeah, for the record, my wife hates it when I dress like a slob, even now.
Fair enough. Fair enough.
And
She might hate it,
we've
but
been
I'm sure
hap-
she still loves you.
she does. We've been happily married for over 30 years. So
Well, that's great. Congratulations.
thank you, thank you. Listen, there was something I just wanted to talk about before before we wrap this up, and it's partly from the fact that when I read up about you and I read about the collaborative fund, I just thought that's hugely interesting. I hadn't realised that. Perhaps you could just talk about that because it looks like such a great venture.
Sure. Like the thesis of the collaborative fund are that companies who use their business ability to do good in the world, to help people, to really have a positive social impact, those companies actually have an economic competitive advantage in the sense that they can attract the greatest number of customers, the most loyal customers, the best employees are going to be attracted to them. So the idea of doing well as a business, ESG investing is often how it's put, has often been viewed as, hey, we're doing good for the world, but it might come at the expense of our returns, of, for our investors. We view it through a different lens. We're like, we want to back companies that are using their ability to do good as an economic advantage. One example that I'll give that is familiar to a lot of people is Lyft versus Uber. They are virtually identical companies. They offer the same service. Of course, 2020 has been a rough year for both of them, but the same service. Their apps look almost identical. There are almost no industries in which the companies are just completely identical to one another. But Lyft has gained a lot of market share over Uber over the last 5 years because it just operates in a little bit more friendly manner than Uber, where Uber is take no prisoners, step on toes, move out of the way, fire your employees when you need to, just no holds barred business, which to a lot of consumers is not very attractive. Whereas Lyft is just a little bit friendlier, just puts forth a more friendly vibe, a more helpful vibe in the world. And that single point has been extremely effective at Lyft gaining market share over the last 5 years. And of course, Lyft has been a very successful company because of it. So there are companies that use their ability to do good as an economic advantage, and that is what we are after at the Collaborative Fund.
Right. So do you look at company values, purpose, um, why they exist almost, rather than just, what is their existence for?
Yeah, I think that's it. It's different for every company, every industry. It's a little bit different. It's not like measuring free cash flow where it's universal from industry to industry. Your ability to do good is different from company to company, and it's often hard to measure. It's hard to quantify, which means that a lot of investors won't pay any attention to it because it can't be quantified. But it makes a lot of difference, particularly from the perspective of a customer who like if customers might not be able to quantify the exact value of Lyft doing good in the world and their friendly demeanor in the world, but for customers, it means everything to them. They're very willing to delete Uber, which was actually a hashtag 2 or 3 years ago, and move towards Lyft. It means the world to customers, even if investors have a hard time necessarily quantifying that impact.
So it's interesting because again, that comes back to that emotional component of finance, which doesn't appear on a spreadsheet.
Yeah, that's right. I love there's a documentary about the Vietnam War by Ken Burns. And there's a part in there I love where they're talking about the Secretary of Defense during the Vietnam War, um, uh, who made this point. His name was McNamara. He made this point that McNamara wanted to quantify every single aspect of the Vietnam War, and if it could not be quantified, it didn't matter. It didn't exist to him. The number of troops, the number of weapons, the number of deaths, everything needed to be quantified and viewed in a chart and a spreadsheet. And they make the point in the documentary that a lot of what went wrong in Vietnam is that the one thing you could not quantify were the feelings of the Vietnamese people. And in the end, that was what really mattered most. That was what set the direction of the war from start to finish, and you could not quantify it. So the thing that you could not quantify is actually what mattered most. And I love that example because I think that really exists in business and investing too, that there are things that you cannot quantify, like feelings and emotions, that we know are not only important, they're some of the most important parts that exist in business.
Yeah, yeah, and we see this happen time and time again. It doesn't appear on the spreadsheet at first, but over time it magically appears on the spreadsheet. It appears on the value rather of the
Exactly.
company, the value that its customers put on it, the value that its clients or its
Yeah.
its relationships with other businesses, producers and suppliers.
Yep.
It always comes through, and I see it when I work in companies, and I go into a company and the company has values, and that you know that that is often seen as something very soft, but it retains its best staff because of that. It attracts customer loyalty, and eventually that appears in the spreadsheet somewhere. It
Of
appears in the
course.
value of the
Yeah.
company.
So it's like the second or third derivative. It's you can't measure it directly at the source, but you can measure it kind of downstream in terms of look, if your ability to do good, which you can't measure, attracts and if that attracts customers and attracts revenue, well, that you can measure, even if it's kind of like a second derivative effect of it.
Yeah, yeah. No, I think this is great, and I know we're close to wrapping up, but I do love this theme of being the book. Really, it's emotional finance, and this is the point that I say when you trade and invest, and I kind of, one of the things I got reading your book was that you slept at night. You always had a good night's sleep.
It's funny you bring
And
that up
that
because
was,
I slept terribly last night. I had one of my worst nights of sleep last night. So as I'm sitting here pounding coffee, it's funny that you bring that up. But in general, I sleep well at night. Yes.
yeah. I mean, do you ever get an investment where you think you can't sleep and you don't know why? And that becomes something that you've got to look into. And it awakes you to something which you weren't sure about.
Certainly, that was true in March of this year when it really looked like we were heading into the second depression. As of today, it looks like we maybe avoided that, but definitely in March, just writ large across the entire economy and across all investing classes, it looked like we were heading into something really, really ugly. And even as someone who studies this stuff for a living and studies, keeping your head on straight during the panics, I was as worried as anyone else. I was worried about the economy, is worried about us, worried about our family. Like it's never fun to go through those things, just as long as you make sure that it does not entice you to make regrettable decisions with your money, because I didn't do anything to my investments back then. I kind of stayed according to plan, but I was as worried as anyone else.
And that's actually, ironically enough, where we get back to the start of this story. You're living in your house which you own, and no one can take it away from you.
Right. Really important. I've always said, I hope I don't jinx myself by saying this, but if we are to go into the next Great Depression at some point, whether it's now or at some point in the rest of our lives, I just want that to be a period where I can just like wait it out. I don't want any decisions to be forced on me. I just want to wait it out because that's when I can if I can keep my career going without having to throw everything away and having to just take up something else just so I can feed my family and keep the bills. And I think if it gives me endurance, financial endurance to withstand the inevitable tragedies that we'll all deal with in life, then it's well worth it.
Absolutely. Well, listen, I'm conscious that we're close to the to wrapping up this podcast. I just kind of want to ask you. And by the way, I've turned over and I see Annie Duke has done a review on the back of the book. She's I love her book, Thinking in Bets. It's along that same sort of Nassim Taleb, that
Yes.
whole sort of that whole kind of genre, which is kind of where thinking about our emotions as we do something.
Yep.
Um,
Exactly.
could you give people maybe a quick summary of the book so they know what they're getting again?
The book is not about what to do with your money. It's about what happens in your head when you try to do things with money, which is a point that I think is so often overlooked, but again, is one of the most important aspects of money. It's structured as 19 short stories, each of which you can probably blow through in 10 or 15 minutes, that have a clear, distinct takeaway that I hope has a lot of detail and I tell a story about, but it's no rambling in there. Hopefully, I don't waste your time on any of the points. I want you to be able to get through it quickly and get something useful out of it, but then I want to respect your time and get out of your way. So hopefully that's what people get out of the book.
Yeah, fantastic, and I'm sure they're going to love it. Morgan, it's been wonderful having you on the podcast, and I wish you best. This comes out on the 8th of September. Is that correct?
That's correct. Yes,
And is there an audible version of it?
there is. Yep, it's on Kindle, physical, Audible. We got all bases covered.
And is that your recording of your voice on Audible?
No, my good friend Chris Hill, who is the Motley Fool's radio host. I used to work at the Motley Fool. Chris Hill's a good friend of mine, and he has a lovely voice, more lovely than mine. So I asked him to do it, and he did a wonderful job.
Fantastic. Okay, well, listen, I'm going to leave you to get on with the rest of your day. And once again, thank you so much for giving us your time today.
Thanks so much for having me. This has been fun. Thank you.
Thank you for listening today. We hope you enjoyed the podcast. If you have been enjoying the Alpha podcast series, we would be delighted if you could rate and review the show on iTunes or whichever podcast service you use. Ratings and reviews help us grow our audience, which in turn enables us to keep bringing you outstanding guests for your education and pleasure. Also, be sure to subscribe or follow the Alpha podcast on whichever podcast service you use, so as to make sure you do not miss future episodes. Thank you to our podcast partner, the Society of Technical Analysts, the STA. You can learn more about their service, becoming a member, and their outstanding technical analysis home study course on the STA website, sta-uk.org. Alpha Mind is a joint collaboration between Mark Randall and myself, Stephen Goldstein. To know more about us, visit our website, alpha-mind.net, or go to the Alpha Mind blog, alphamindblog.blogspot.com. There you can subscribe to our new newsletter. You can also follow us on social media. My Twitter handle is @AlphaMind101 and Mark's Twitter handle is @AlphaMind102. Or connect with us on LinkedIn and join our Alpha Mind LinkedIn group. Thank you once again for listening, and we hope you have a great week.